Okay, good morning. Good morning. It is Wednesday, August 7th. Happy August. Happy Wednesday. It's time for our weekly webinar. So I want to welcome everybody. And today we are going to talk about market corrections in our financial focus. So this is a timely topic, obviously. So here we are, August 7th, 2024. Last week we had quite a significant drop in the markets overall. I'm going to talk in the weekly webinar section in some detail about what those drops were, but in the financial focus, we're going to focus on market correction and what should you do now. So I'm adding to this Do This Now series that we started about a month or so ago. So I'll discuss what a market correction is and what you should do in response or for preparation. I also want to remind you of our goals. So the goals for the listeners of this YouTube video or for the podcast, if you're listening on the podcast, is education. So I don't believe that you should be taking financial advice from anybody on a podcast or on YouTube, but it's a great place to find education and perhaps find the direction for yourself or find the right people to work with so that you have the tools to answer questions you need and find the direction that you need. Good morning, Keith. Good to see you. So my goals for you in this education process is to be inspired to make changes, to open your mind to different ideas and different ways of thinking about planning and investing. During the financial focus today, we're going to talk about building your investment foundation because, again, today is about market corrections, what we're going to talk about. But you've got to have a strong foundation for your investments. And we do things very, very differently, and very, very few people, I'm proud to say, do it. I'm disappointed to say that, but proud to say that we do it differently than others. But open your mind to different ideas and ways of thinking about planning and investing. Stay educated so you feel confident in that plan, in your plan and strategies that are put in place. And keep listening and stay updated so you can make adjustments along the way. So they're my goals for you. Now, we're going to follow our typical format today, and we're going to have some material from the Slott group. And I'm going to share that with you on my screen so you can read along. So if you're just listening to this on YouTube or if you're listening on the podcast, you can go to the YouTube channel and watch the video, and you'll be able to read along. So let's get into the Slott section, and I'm going to share my screen here. And the first report is by Einberger. This just came out. Today's the 7th. This came out on Monday. And it has to do with more updates on the final regulations on the Secure Act. So the IRS just released, I guess a couple weeks ago now, final regulations for the Secure Act. So we've been working under proposed regulations, and some things have been clarified and some things have changed a little bit. So we're going to talk a little bit today about what's changed regarding eligible designated beneficiaries. And the headline to this Slott report is the IRS final regulations loosened the definition of eligible designated beneficiary. So Ian writes, one of the positive outcomes of the new IRS final Secure Act regulations on required minimum distributions released on July 18th is that more beneficiaries will be able to stretch RMDs over their lifetime. So good news. Under the 2020 Secure Act, only a certain class of individual beneficiaries, known as eligible designated beneficiaries or EDBs, of IRAs and company plan accounts can use the stretch. So the stretch, there's no official stretch IRA terminology that you can find in the tax code. It's just known as the stretch IRA. And the stretch IRA allows somebody using the uniform or using one of the lifetime tables to be able to calculate what an amount that they can take every year, a minimum amount that they can take every year. And the idea always is that the amount that you take will be significantly more if you're allowed to take it over time. You can delay the tax burden. You can stretch that over time. So anybody had that opportunity to do that prior to the Secure Act, and the Secure Act greatly reduced the people who can do these stretch IRAs when you inherit an IRA. I'm talking about when you inherit an IRA. So moving on, individual beneficiaries who are not EDBs must instead now use a 10-year payment rule. And there's some nuances with a 10-year payment rule as well. Under the Secure Act, EDBs are designated beneficiaries who are 1, the surviving spouse of the IRA owner or plan participant, 2, a minor child of the account owner, 3, and these are all ors, not ands, so or a minor child of the account owner, or a disabled individual, or a chronically ill individual, or a person not more than 10 years younger than the account owner. The final regulations don't expand these categories, but the regs do make it easier for certain people to fit into one of these categories. So let's talk about minor child. Minor children. A child of an account owner is an EDB if the child is under 21 when the account owner dies. It's written as EBD, but it should be EDB. Eligible designated beneficiary. So a child of an account owner is an EDB if the child is under age 21 when the account owner dies. The final rules expand the definition of child to include legally adopted children, stepchildren, and foster children. That's very helpful, particularly the stepchildren. Disabled individuals. Under the Secure Act, someone is considered disabled if they are unable to perform any job as a result of a physical or mental impairment which can be expected to result in death or continue indefinitely. In the final regulations, the IRS provides an alternative definition that can be used when the beneficiary is under age 18, when inheriting an IRA or plan account. So when they're talking about plan account, they're talking about a 401k plan, a 403b plan, something like that. The alternative definition replaces the requirement that the beneficiary's impairment makes it impossible for him or her to perform any job, with the requirement that the impairment causes severe functional limitations. The alternative definition should make it easier for young beneficiaries to meet the disability standard and become an EDB. Wouldn't a disabled child, so he posts some questions. So wouldn't a disabled child under 18 automatically qualify as EDB on account of being a minor? Yes, but a disabled child who turns 21 would remain an EDB, while a child not disabled would become a non-EDB and become subject to the 10-year payment rule at age 21. The final regulations also say that someone who has been found to be disabled by the Social Security Administration is automatically considered to be an eligible designated beneficiary. Documentation of disability or chronic illness. The Secure Act requires that documentation of disability or chronic illness be provided to the IRS custodian or plan administrator. The IRS previously required this documentation to be given by October 31st of the year following the year of the account owner's death. These rules raised privacy concerns. In response, the IRS completely waived the certification requirement for IRA beneficiaries. For plan beneficiaries, the IRS said the certification need not be overly detailed and can be satisfied without providing backup documentation such as medical records. In addition, a disabled or chronically ill beneficiary who inherited a plan account in 2020 through 2023 and did not provide the required certification by October 31st deadline has until October 31st, 2025 to do so. So we'll continue to have more information from our group of analysts at the Slott Group on these regulations. I think I shared with you folks that it was over 200 and some pages. So these final regulations. So we're going through that. So this is the Slott Report mailbag. So this is when people write in with questions and the analysts answer, and these are always fun. But today, this is written by Andy Ives. And the first question is, I inherited both a traditional and a Roth IRA from my significant other, non-spouse, who passed away in 2021. He had started taking required minimum distributions. I am less than 10 years younger than he was. Question is, do I or do I not have to empty both accounts within 10 years of his death? No one is giving me an answer one way or another. It is hard to find answers to these questions, and there's a lot of misinformation out there. You know, I've said this so many times. RMDs for inherited IRAs, inherited retirement plans, have always been a confusing topic, but it has got more and more confusing at every passage of new tax code changes. So it's really important that you find qualified individuals to answer questions. And just because they have certain letters after their names, it doesn't mean that they're qualified. So Andy writes, there are a few moving parts here, so it's no surprise you can't find a straight answer. Since you are not more than 10 years younger than the deceased account owner, you qualify as an eligible designated beneficiary under the Secure Act. As an EDB, eligible designated beneficiary, the payout structure is based on the type of account. For the traditional IRA, you can take annual stretch required minimum distributions based on your own single life expectancy. Use your age in 2022 to determine the original life expectancy factor, then subtract 1 each year thereafter. The 10-year rule does not apply. For the inherited Roth IRA, you have a couple options. As an eligible designated beneficiary, you could choose the 10-year payout rule. There are no RMDs within the 10-year period on inherited Roth IRAs. That's because, just as a sideline here, that is because what triggers the need for required minimum distributions for an inherited beneficiary or an inherited IRA beneficiary during that 10-year period is if the original person who had the IRA, the deceased, had passed their required beginning date. So they were required to take their required minimum distributions, like in the case of this person here. However, Roth IRAs don't have a required beginning date because there are no required minimum distributions from a Roth IRA. So there are no RMDs within the 10-year period on inherited Roth IRAs because there are no RMDs required by the deceased, the original account owner, on Roth IRAs. Or you could choose lifetime stretch RMD payments. These RMDs would be calculated the same way as the traditional IRA. Next question. I have purchased your books and followed your articles over the past 25 years. Thank you for the knowledge. Next year, I am required to take my first RMD as I will be age 73. I've been retired since 2019. I've never taken any distribution from my 401k and have appreciated company stock. I understand a net realized appreciation or NUA transaction can count towards an RMD. EDBs, NUAs, RMDs. I love all the nice initials. My question, does both the cost basis and the NUA portion count toward the RMD? Or does just the cost basis count toward the RMD? I have received some conflicting answers to this question. So I have a great video with Andy talking about NUAs. So I'm going to put that in the description. So if you have a question about NUA, this is another complex topic. So an NUA allows you to move company stock from a retirement plan, and it's taxed. It can be taxed more efficiently. So it's also a complex process. We just did that for somebody just a month or so ago, then significant tax savings for them. So if you have company stock in your 401k, NUA is something you're going to want to explore and learn about. It may not be a process you ultimately want to do, but you certainly want to learn about it and explore about it. So this person says, I've received some conflicting answers to this question. Again, because not many people really truly understand MUA. So the answer, Dom, yes, you can leverage the NUA tax strategy in conjunction with an RMD distribution. It appears you may be eligible for NUA as you have hit the separation from service trigger. There are multiple triggers with NUA, or net unrealized appreciation. So this person has hit the separation from service trigger and have not touched the 401k. If you pursue an NUA distribution, only the cost basis will be taxed as ordinary income in the year of distribution. However, the total NUA distribution, cost basis, and appreciation will count toward your RMD. Really, really great information. And I know it's very technical and detailed, but again, my goal for you is just to be knowledgeable about these potential issues and be able to identify, kind of a flag, like, okay, let me check in with a qualified person. You can reach out to us. You can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. You can go visit our website at attleborowealth.com. One of the things that we talked about was the calculations done for inherited IRAs and even your own IRAs. You can find those on our website. So if you go to attleborowealth.com and you go to the slot corner, under Education and Resources, and you choose Slot Corner and scroll down to the bottom of the page. There are tax guides there, including the uniform lifetime table and single lifetime table that you can download for your use in calculating these things. No cost, just put your email in and you'll be all set. Okay. Moving on to the markets. Boy. So what the heck happened last week? So let's talk about some of the things that went on, and then we'll talk about the markets. So the Fed had its meeting last week, and the Fed funds the Fed kept the Fed funds rate steady at 5.25 to 5.5% as expected, and made several changes to the statement that indicated risks were in balance between inflation being too high and economic growth being too slow. Now, that was before we had some jobs reports on Fridays, but that's what happened with the Fed meeting last week. So they said they didn't say likely September, but the feeling is likely September we're going to see a rate decrease. The analyst writes, the Fed under Chairman Powell has been careful to avoid surprising investors, and this meeting reinforced that goal. The Fed kept rates the same as expected, but set up the possibility for a rate cut to their next meeting, again September, as long as inflation readings come in as expected. We had ISM manufacturing reports. The measure of manufacturing sentiment declined to 46.8, down from 48.5 readings seen in June. The new orders component also remained in territory depicting contraction, so slowing, falling from 47.4 falling to 47.4 from 49.3, while the price index still rose 0.8 points to 52.1. So orders came down, prices went up. Analyst says manufacturing continues to struggle, and with global economic growth appearing to slow, it seems that manufacturing activity could get worse before it gets better as the Fed rate hikes begin to have a greater impact. Then we had a labor report. The labor report reported, so this was Friday. This was a big one. We're seeing some significant slowing in jobs. So the Labor Department reported that 114,000 jobs were added in July, below expectations, while unemployment rose to 4.3% from 4.1%. Average hourly earnings rose 3.6%, which was the smallest annual gain since May of 2021. So we're seeing unemployment rise. We're seeing less jobs added, and we're seeing earnings increase slow. All signs of a slowing economy. So now the fear is, what you're hearing from the talking heads is, okay, well, are we going to bypass this soft landing? Or are we going to hit a hard recession? Well, we won't know that until we're in it, right? But now people are saying maybe the Fed's acting too slowly. Our analyst writes about this jobs report. This report helped to fuel increasing investor fears that the economy is slowing rapidly and that the Fed is behind the curve. One report doesn't make a trend, and the economy is still adding jobs, but evidence is building that the U.S. economic growth is slowing. So this week, Monday we had ISM services. This Thursday we have initial jobless claims, and that's it for this week. This coming week. All right, let's see what other folks. Well, let me first give you what happened in the markets last week. So at the end of the week, at the close of business on Friday, this is where we were. The Dow Jones Industrial Average was down 2.1%. So that doesn't sound like a lot, but the numbers are large because the Dow's now trading at, it closed on Friday at 39,737. So we see, I think it was 1,100 or 1,300. It was down 1,300. They're big numbers to see on the screen, and they can cause, they can cause concern. And you have to remember that when we have volatility, we'll see more volatility because many things are run on algorithms now. So I don't know if there's more algorithms than people or are more people than algorithms making these decisions now, but the algorithm is going to say at a certain level, we're going to sell all of our positions or a portion of our positions. And now those positions can be the entire market because you can own the Dow Jones Industrial Average. You can own the S&P 500 using exchange traded funds. There's thousands of them now. You just pick your flavor, and you can buy and sell the whole market. So when a computer algorithm says, "Okay, we're down 2%. If we're down 2% in the Dow, we're going to start selling." Or maybe we start buying on the other side. Who the heck knows? But this happens automatically without some human saying, well, these are reasons we may want to wait or not. So the reason I'm saying that, I'm not saying it's a bad thing. It just is the state of our trading systems these days. Is when we have volatility, that causes more volatility because these algorithms and computer systems just act. So the Dow Jones Industrial Average was down 2.10%. The S&P 500 was down 2%, 2.06%. The Nasdaq was down 3.35%. The S&P Mid Cap 400 was down 4.13. The Russell 2000 was down 6.67% last week. Wow. And the Russell's taken, so the Russell 2000 is smaller U.S. companies, not like your mom and pop shop or the size of Attleboro Wealth Management, but smaller publicly traded companies. But they've been struggling anyway, and they got clobbered last week. The Bloomberg U.S. Aggregate Bond Index was up 2.43%. So this is the index that I'm watching right now because I'm finding it interesting. Because as interest rates go down, we should see some increase in that index. Now, this is not a recommendation to buy, sell, or hold any position, including the U.S. Aggregate Index, the Bloomberg U.S. Aggregate Index. But this has been just flailing for, it feels like 2 years now, where it's down, it's slightly up, and for that kind of move, 2.43% in the bond index is significant. So that's a 7 to 9 year maturity. That's where most people have their bond holdings. So the Empower Group had an interesting take on what happened with the FOMC, the Fed. So they write, until very recently, Powell and this is an excerpt. Again, this is a multi-page report. This is an excerpt that I grabbed from there. Until very recently, Powell and his pals were really only working with one side of their mandate. So they have a dual mandate, the jobs, the employment, and inflation. So they've only been working on the inflation side. Sure, that's been sticky enough, they're saying, and if you haven't heard the phrase sticky inflation in the last 6 months, then you really haven't been paying attention. So this analyst is writing, he's talking about double-sided sticky tape. He used the analogy of double-sided sticky tape. So when he's talking about inflation being sticky, he's talking about one side of the tape. But it's also a reasonably straightforward task. He's talking about inflation, kind of the monetary policy equivalent of using Scotch tape to affix wrapping paper to my nephew's birthday present, he writes, right, instead of using double-sided sticky tape. But all that changed last week when the Fed finally acknowledged not just that the risk between inflation and unemployment are closer to being balanced, but that the jobs market has weakened enough to force the Fed to begin paying closer attention. I think the downside risks to the employment mandate are real. Now, the time is coming at which it will begin to be appropriate to dial back the level of restrictions so that we may address both mandates, Chairman Powell said. Translation is the Fed is almost as worried about jobs now as it is about inflation, and that means rate cuts are probably coming. So we see, I've shared with you that rate cuts, the probability of rate cuts have increased dramatically, where it was about 35%. 45% a few months ago. Now, just about everybody's expecting rate cuts. And we talked about this, but they refer to the Bureau of Labor Statistics released on Friday its monthly employment situation summary, a catalog of data that includes the unemployment rate, now at 4.3%, non-farm payroll growth, positive, only 114,000 jobs in July, and the labor force participation rate, 62.8%, together with all sorts of other helpful stuff. That term is his, helpful stuff. Pretty much all of it, except participation rates, were worse than expected and consistent with a job market that is now rolling downhill on its own momentum. So the concern is that the job market is exactly what he said, rolling downhill on its own momentum. That's a really great way to put it. So that's the market snapshot. So I'm watching the time closely. I'm going to give you a heads up, folks. I'm watching the time closely because I've got to stop at about 10 minutes before. So if it feels like I'm going through the next section quickly, it's because I am. So we're going to move into the financial focus section right now. All right. So this is the financial focus section of our weekly webinar. So this is the last section of our weekly webinar. If you're just joining us for this segment, then please hit the like, subscribe, and notification buttons. We've had a big increase in subscribers over the past few months, and I really appreciate you folks for that. But hit that like, subscribe, and notification button so that you're notified as soon as these videos are launched, because this big 45-minute to 1 hour webinar, we break down and we separate the financial focus. So you get 2 videos out of here. You can watch the full weekly webinar that we just went through, or you can just pick out this financial focus. And this week's topic is market correction. Do this now. So we've had this series, this Do This Now series, where I talked about what to do if you're age 55 and preparing for retirement, 5 years from retirement. I think it went 5 years from retirement, 2 years from retirement, 1 year from retirement. But with all the market activity last week, my inspiration for this video was, well, holy cow, market correction. Do this now. So we're going to talk about what you should do in a market correction. In response and in preparation for. So let's get into it. I'm going to share my whiteboard, and you're going to see me looking down, looking at my whiteboard, and then you're going to see my little face there with it. But follow along with me here. So I'm going to share. Okay, so the first thing we want to talk about is, what is a market correction? So follow me over here. I have a definition. A market correction is when an index is down 10%. Really kind of simple. The NASDAQ is currently in correction territory, right? So the NASDAQ, as of close of business yesterday, was down 12%. And let me just say, because I said it during my webinar, but I'll say it here, I'm going to be referring to different indices, the S&P 500, the NASDAQ in particular. Any mention of any indices or any individual company is not a recommendation to buy, sell, or hold those companies or indices. And in fact, this entire segment here and an entire webinar is about education, not advice. It's very, very important that you don't get your advice from anybody on YouTube or podcasts. It's good to get education, but not advice should be specialized. It should be tailored for you, specialized for you. Okay. So market correction is when the index is down 10%. The NASDAQ is in correction territory. As I said, 12% right now as of close of business yesterday. I don't have my screens up right now, so I can't tell you where it is now. And the S&P 500 came within 10% down as of Monday. So here we are, Wednesday, 2 days ago. Now, just so you know, a bear market is when an index is down 20%. So a market correction is down 10%, and a bear market is down 20%. So, we're overdue for a few things, and we're overdue for a correction for sure, and we're overdue for a recession. And I just want to share this chart with you. So I pulled up this chart that took a look, going all the way back to 2008. So if we go all the way back to 2008, and of course 2024, this shows market corrections and bear markets. So the pink are bear markets, and the light blue are market corrections. So follow me along here, because we see there's no pattern to be found, folks. You can't. There's don't be looking for technical analyses where you can predict these things. What you want to see is that it just several times, even if you just went back to 2018. Let's just go back there. This short period of time. We've got 1, 2, 3 corrections. Now and then one bear market, and that was 2022. A bear market here, so 2 bear markets. So 2020, so obviously COVID. You can't blame everything on COVID, though. We do have bear markets, and we do have corrections for sure. But we had in this period of time since 2018, 1, 2, 3 corrections, and 1, 2 bear markets. So these happen, and you have to prepare yourself for it. Okay. Let's bring me back. Now we know what a market correction is. An index down 10%. So what should you do in these situations? So I don't know, our phones were very quiet last week, and I appreciate that. Our clients don't panic. And I believe that's because they know that our investment decisions are driven by our plan. They also know that we have a strong investment foundation, and we're going to talk about that. We constantly make adjustments, and you should do that too, but perhaps not in response to a market correction. You should really be set up for this. So the first thing that you should be doing is reviewing your plan. So you might just say, oh, geez, Mark, you're a broken record about reviewing your plan. But you must review your plan. You should review your plan on a regular basis, and there's nothing wrong with reviewing it when things are challenging. So the reason that you want to have things, review things on a regular basis is that so you're not reacting. So if you know me, you know that I spent many years in law enforcement, and I was in the military as well. So when you're in law enforcement, you do, and they talk about when the stuff hits the fan, right? So when somebody's giving you a hard time, or you're engaged with someone in a negative way, or heaven forbid you end up in a firefight situation, you rely on your training and experience. So you respond with things the way you're trained and the way you constantly do these things. So that's maybe an exaggerated way of explaining the benefit of having these reviews and reviewing your plan, and not just letting that thing sit on the shelf. Because if you're having these discussions every year, you understand what could potentially happen in a market correction or in a bear market, and you see how your investments are lined up per your plan to offset these things, or to prepare for these things, to give you that strong foundation. I hope that makes sense. So it's just like, you want to rely on your training and experience, just like we did. Your training and experience is, hey, I review the plan every year. I see what we're doing. I learn from my team what's happening, and the experience is, okay, I've done this every year. I've seen it. I hear these checks that are in place every year. That's really your training and experience. So review that plan. Ensure your foundation is solid. I've often given this example. When I was first out of the Air Force, I worked at the San Francisco Hilton. I remember standing on the roof in the San Francisco Hilton, talking to a coworker, so way up on the roof, and I was looking at the buildings around us. And there's some beautiful buildings out in San Francisco, but the person was telling me that these buildings are built in a very architecturally different manner than most in most cities. They're built with the idea that they're occasionally going to have earthquakes. So I think it's a Transamerica building, but one of them is built kind of on a big ball bearing so that the building can move and it'll crack, but it won't fall down. That's how I think about our foundation for investments. We know that there's going to be times that the markets are down and parts of the investments are going to going to not have positive returns, and we're going to see negative returns. And that's going to crack not our foundation, but our plan a little bit, but it shouldn't bring it down. And certainly it should allow for recovery. So you want that foundation to be solid. And I'm going to bring you over here to talk about your foundation. And this is another video. I can't go through the entire 3-pillar section here, but I have a video on this called the 3 Pillars of Investment Management. Just write this out: investment management. And this is what we follow here. And this is what, this is what I teach, and this is what we follow here. So the 3 pillars of investment management are, number 1, asset allocation. So whether it's intentional or whether it's happenstance, you have some sort of asset allocation. It should be intentional. Your asset allocation should be intentional. Where the pieces of your pie are invested and how they're invested. Number 2 is principal protection. We believe that for most people, a portion of your investment should be in something that in any given year, the worst return you're going to have is 0. So you can have positive returns, but you'll never have negative returns. So that helps you by never having to climb out of a hole. So when the markets are like this, right, you're basically erasing these. You're erasing these holes. A portion of your investments, we typically use a third. So 1/3 of your investments should be in something that's principal protected. And there's a few different options that can answer that need. And the last is account segmentation. And let me just go back to principal protected. You not only want this principal protected, but you want effective growth as well. So we refer to it as safe and effective, right? Because if you just hide it underneath the mattress, it's not going to help you. So we typically recommend up to a third. Sometimes it's a half, but be careful not to over allocate into these principal protection strategies. Number 3 is account segmentation, and this gets really, really complex. So most people, all professional advisors, stockbrokers, whatever you want to call them, 100% do the asset allocation. Probably about 50% of the folks, the planners and folks like me out there, also incorporate some level of principal protection. Hardly anybody does account segmentation because it is a tremendous amount of work. And I can feel my staff nodding their heads right now, but I'm just going to give you a snapshot on what account segmentation is. And remember, this is your foundation, folks. You build that foundation with these 3 pillars: account asset allocation, principal protection, and account segmentation. Account segmentation says instead of taking just some derived allocation portfolio from maybe some risk questionnaire and saying, geez, I got a 60-40 portfolio, 60% stocks, 40% bonds, and the bonds are going to zig while the stocks zag. It just doesn't always work that way. And when you're taking money out of a portfolio that's down on one side or the other, and you're taking withdrawals for expenses, right? You never get to recover from significant market drops. So remember, a market correction is 10%. Well, that doesn't feel too bad. But I want you to think about what I said, and if you weren't with us during the entire weekly webinar, the S&P 500 last week was down just over 2%. The Dow Jones was down just over 2%. But people were panicking a little bit. Not our folks, our phones were quiet, but people were getting panicked. Everybody starts talking about the market again. The NASDAQ is the only index that's in true market correction. So we're not even there yet. Now a bear market is down negative 20%. And go back to this chart here with me. It's a common occurrence. So just in the past several years, since 2018, right? So almost 6 years, we've had 2 bear markets and 3 market corrections. So it's not an uncommon occurrence. So account segmentation says instead of having one portfolio that's some derived portfolio allocation, 60, 40, 70, 30, whatever it might be for you, we create individual portfolios for when you're going to need funds in your lifetime. Again, this is very detailed. I'm not going to go into all the details. You can see it on a video. If you're just listening to me on the podcast, and I'm Not a Guru podcast, you can see what the whiteboarding. I'm whiteboarding right now these different things, and you can go to our YouTube channel and view the whiteboard. But what I'm illustrating here is I have a portfolio above and then multiple portfolios below along a timeline of years. So these are your years, and let's just say for retirement. Instead of saying that one portfolio is going to sustain us in the 20, 30 plus years of retirement, we're going to break this down into individual accounts that slide into these slots for your funding. So when you see here, I have a section that's showing just 0 to 3 on my whiteboard. And now I have dollar signs underneath it because that is the amount of money needed during that period of time. So if your amount of money that you need in the first 3 years is $200,000, we're going to put that in a very conservative account allocation. And we're going to keep these accounts separate because psychologically we need to be able to point to those accounts when the stuff hits the fan and the market is down 30%. You know that your first 3 years, your second 3 years are well protected, that there's not going to be a lot of volatility. There's actually no volatility in this, so there's no risk of loss, just interest. Thankfully, today we're getting still very good interest. That will change as interest rate cuts start to happen. But right now we're averaging almost 5% in that first segment. We refer to that as segment 1, and here we have segment 2 and segment 3 and that's an S, segment 4, segment 5. And this is typically our legacy longevity when we go out 18 plus years. What does legacy longevity mean? Legacy longevity means that is money you're likely not to need during your lifetime, but it's there for you if you want to spend it during your lifetime. So this is typically the legacy longevity all the way out here in the 18 plus years. That's typically our most aggressive allocation. And the segment 1 is our most conservative allocation. And then it expands as you move out your timeline. So it becomes, your allocations become more aggressive the further out you in time that you're going to need those funds. The reason that's important is because, first of all, you can't afford the wild fluctuations early in your withdrawal schedule. I'm talking to you folks who are getting ready to retire, but you also need the growth. You know, inflation is going to be with us for the rest of our lives. Where 100-year inflation average is 3.5%. We've been really jaded by the low inflation we've had. So really just count on 3.5%. That's a really good place to start. But you're going to need some growth in your investments to help overcome that inflation. And then all this, once you set it up, it all has to be adjusted all the time. And the components within these little pie charts I drew are very, very important as well. So that is really your foundation without going into too much detail, but really I invite you to do a couple things. First of all, if you have questions about this, you can reach out to us at questions@attleboroughwealth.com. If you want to schedule a 15-minute phone call with me, you can do that by hitting the link in the description and schedule that time. I'm happy to walk through this. You can also go to our YouTube channel or to our website and look for this 3 pillars of investment management. And actually, it's going to be linked in this description here. So you can watch this in more detail, and I'm really fighting not to get into that detail. So build that foundation. Ensure your foundation is solid. Make adjustments. Don't sell in panic, but make adjustments where you need to. So when all this was going on last week, I went through it, and we have an excellent investment team reviewing portfolios, and where people are out of allocation, perhaps they have things where they have low cost basis and tax issues and things like that. I went through and looked at any adjustments we may have to make if this becomes a longer kind of issue. And we may make some adjustments in clients' portfolios. You know, we have a strong foundation, but there are some outliers out there for like I said, tax reasons and things like that we may have to make an adjustments. But plan you want to have those adjustments identified. Like, I'm going to make this adjustment in this case. You don't want to be reactive to these unless you're completely out of whack, unless you're just so over allocated to something, and it's we've seen a lot of tech that's fallen out. I've had a lot of people over the past year saying, I don't want to sell this stock because it's just so high. And I know they wish they would have made a change. So you've got to make these adjustments, but don't do it out of panic. Don't do it out of fear. Do it for the right reason. Have a plan for that, and have it track your financial plan. Consider options for protection. So there's a lot of things today that will buffer downside of your loss. There are things that will offer you principal protection. As I said, I believe that should be part of a good investment strategy. It all depends on what your needs are. Everything is very individual, of course, but consider options for protection on some level, whether it's principal protection or buffered strategy, and then monitor and adjust periodically. Don't wait until the next shockwave. If you review your investments, and let me step back for a second. I'm going to write down here statements, because I have a little bit of a pet peeve that I'm going to share with you. Other financial advisors say this thing all the time to their clients. Just don't open your statements right now. Don't open your statements right now, so you're not going to worry about it. That is the craziest thing. Open your statements and be aware of what the effect is, and ask questions if you're not sure why you're experiencing these drops. It is easier for a financial advisor to say, hey, don't open those statements, because then their phones are going to ring less. That is not why our phones weren't ringing in panic last week. Open your statements. Pay attention to it. This is your money. It's your responsibility. We are stewards of helping you, for sure, but it is ultimately your responsibility. And you should be knowledgeable you don't have to be expert, but you should be knowledgeable about what's going on in your overall picture, at least. So open those statements and review those statements. Monitor and adjust periodically. Don't just wait for the next shock. Don't just wait for the next whatever. Have your strategy. Do your annual reviews, your periodic reviews for, hey, we're checking in. How are things running? Do we need to make any changes? And of course, that annual financial planning process. You should review your plan. How often? Well, every single year. So monitor and adjust periodically. Folks, these are the things you should be doing in a market correction. These are the things that you should be doing to prepare for potentially a bear market. These are the things that you should be doing anyway. So don't do them in reaction. Just do them to be good at managing your financial life, right? These are good practices to have in your financial life. Maybe you're the type of person that runs right alongside and works aside your financial planner or financial advisor. Maybe you do it all yourself, or maybe you're the person that just says, I have a good financial planning team, financial advisory team, and I let them take care of everything for me. Whatever your method is, it's fine, but just be the best you can on it. Be educated, be aware, open those statements, be aware of that. And you should be doing these things anyway. Review your plan. Ensure your foundation is solid. Make adjustments, consider options for protection, and monitor and adjust periodically. So these are not just things you should be doing during a market correction or a bear market. You should be doing them on an ongoing basis. So make sure you're doing that. All right, that is our webinar for today. I hope this was helpful. I hope you enjoyed it, and I hope I see you next week. That's it, folks. Take care. Bye-bye.